Welcome back to Bonnie's Life, the only place where we dissect the markets with enough precision to make Wall Street jealous and just enough humor to keep you from crying when your portfolio is down. Today, we are diving deep into the current state of the cryptocurrency market. Whether you are a short-term scalper looking for the next quick flip, a mid-term swing trader riding the waves, or a long-term holder with diamond hands and nerves of steel, this episode is your ultimate survival guide. We are going to break down exactly what type of market we are in right now, analyze the critical data from CoinGecko and CoinGlass, and lay out actionable strategies for every type of trader. So, grab your coffee or whatever gets you through these volatile times, and let us get into it. Let us start by identifying exactly what type of market we are currently trading in. If you have been watching the charts lately, you might feel like you are on a roller coaster that forgot to install the safety brakes. As of March 18th, 2026, we are undeniably in a complex bear market. But it is a bear market with a surprisingly healthy foundation. Bitcoin is currently trading around $71,391, which is down about 43% from its all-time high of $126,080 back in October 2025. The total cryptocurrency market capitalization sits at $2.52 trillion, having shed 3.6% in just the last 24 hours. The 24-hour and trading volume across the entire market is hovering around $103 billion. Now, when you see a 43% drawdown from the peak, the traditional definition screams bear market. However, unlike the catastrophic collapses we saw in 2022 with Terra Luna, Celsius, and FTX, the underlying infrastructure of the market right now is robust. Decentralized finance total value locked is actually climbing to $97.6 billion, and stablecoin market caps are at all-time highs of $317 billion, meaning capital is parked on the sidelines, waiting for the right moment to strike. To truly understand the sentiment driving this market, we have to look at the Fear and Greed Index. Right now, the index is sitting at 27, which puts us squarely in the fear zone. In fact, we recently experienced a streak of 38 consecutive days in extreme fear, the longest sustained period of terror since the Terra and Luna collapse in June 2022. When the market is this fearful, retail investors are typically panic selling, while smart money is quietly accumulating. This fear is palpable when you look at the derivatives market. According to CoinGlass, total open interest across exchanges is currently at $108.4 billion, which is down 5.2% in the last 24 hours. This drop in open interest indicates that traders are closing their positions, likely due to the extreme volatility and uncertainty. Furthermore, we have seen nearly $388 million in liquidations over the past day, with the long-short ratio showing shorts slightly dominating at 51.5% versus 48.5% longs. The market is tense, and leverage is being flushed out systematically. Now, let us zoom in on Bitcoin's technical performance across multiple time frames. Looking at the daily charts, Bitcoin's Relative Strength Index, or RSI, is sitting around 59. This indicates firm positive momentum without being overbought. However, the shorter time frames tell a slightly different story. On the 4-hour and 1-hour charts, we are seeing a short-term downtrend followed by consolidation, with lower highs forming, which is a classic bearish structure. The average RSI across the broader market, according to CoinGlass, is 41.31, which is neutral territory. The key resistance level to watch right now is $74,000. If Bitcoin can break and hold above $74,000, the next major hurdle is $76,000, leading into a heavy resistance zone between $93,000 and $98,000. On the downside, our critical support levels are $70,000, $63,000, and the psychological floor of $60,000. If Bitcoin falls below $70,180, CoinGlass data suggests we could see a massive $1.79 billion in long liquidations. This means the market is currently coiled like a spring, and a breakout in either direction will likely be explosive. Ethereum is also painting a fascinating picture that deserves our full attention. Currently trading at $2,192, Ethereum is down about 6.4% over the last 24 hours and remains a staggering 55% below its all-time high of $4,946 set in August 2025. The ETH BTC ratio has dropped to 0.0307, down 2.3%, showing that Ethereum is underperforming Bitcoin on a relative basis. Despite the brutal price action, Ethereum's network fundamentals are incredibly strong. Active addresses and smart contract interactions are at record highs. The Ethereum Foundation recently deployed $7.5 million into the Morpho DeFi protocol, signaling continued confidence in the ecosystem. USDC holdings in top Ethereum wallets have reached an all-time high of $32.7 billion. Ethereum is also dominating real-world asset tokenization with $15.6 billion in RWA value. Technically, Ethereum is facing significant liquidation risks. If the price drops below $2,206, we could see over $1.15 billion in long liquidations, and there is over $2.5 billion in total liquidation risk amid the FOMC decision. This divergence between strong network usage and weak price action is a classic hallmark of a late-stage bear market, reminiscent of the setup we saw in 2019, before the massive DeFi summer bull run of 2020. We cannot analyze the crypto market in a vacuum because global macroeconomic events are currently the primary drivers of price action. The most immediate catalyst is the Federal Open Market Committee, or FOMC, meeting concluding today, March 18th. The Federal Reserve is widely expected to hold interest rates steady between 3.5% and 3.75%. However, the market is not just trading the rate decision, it is trading the dot plot projections and Jerome Powell's press conference. With recent weak U.S. producer price index data and the implementation of a 15% global tariff by the Trump administration, expectations for rate cuts have been pushed back significantly. Goldman Sachs now expects the first cut in September 2026, Morgan Stanley says June 2026, while JP Morgan predicts no cuts at all this year. When rate cuts are delayed, risk assets like Bitcoin typically suffer as liquidity remains tight. The Coinbase premium is currently negative, which is another bearish signal indicating that US-based institutional buyers are not aggressively accumulating at these levels. Adding fuel to the macroeconomic fire are the escalating geopolitical tensions that have rocked global markets. The recent coordinated military strikes in the Middle East, specifically involving Iran, have triggered massive risk-off sentiment across all asset classes. This conflict caused the largest oil supply disruption in history, spiking energy costs and sending shockwaves through the global economy. Gold futures have surged to $4,869 per ounce, reflecting the flight to traditional safe havens. During these initial macro shocks, Bitcoin did not act as a digital safe haven. Instead, it traded like a high beta tech stock, dropping sharply as investors rushed to cash. As Blowfin Research has noted, Bitcoin is often sold first during macro risk events because its perpetual futures market structure embeds a persistent long bias. This geopolitical instability, combined with the shifting halving cycle dynamics where we are now 18 months post-halving, a traditional time for cycle peaks, creates a highly volatile environment where sudden, violent price swings are the norm rather than the exception. The Bitcoin exchange balance has also increased by 15,970 BTC to 2.47 million, suggesting that holders are moving coins to exchanges, potentially preparing to sell. So, how do we trade this complex macro-driven bear market? Let us start with the short-term traders, the scalpers, and day traders. In a market characterized by high volatility and massive liquidation pools, your best friend is strict risk management. The strategy here is to trade the ranges and hunt for liquidity grabs. For Bitcoin, you want to set alerts at the key levels, $70,000 for support and $74,000 for resistance. If the price spikes into the $74,000 resistance and shows signs of rejection on the 15-minute chart, such as a bearish engulfing candle or a shooting star pattern, that is a short trigger, targeting the middle of the range around $72,000. Conversely, if we see a rapid flush down to $70,000 that quickly gets bought up with a long lower wick and a volume spike, that is a classic liquidity sweep and your long trigger. Keep your leverage extremely low, no more than 3 times, because with $1.79 billion in long liquidations sitting just below $70,000, A sudden wick could easily wipe out over-leveraged positions. Always use tight stop losses and do not hold positions overnight while geopolitical news is breaking. The funding rate on Bitcoin is currently at 0.0005%, which is nearly neutral, meaning neither longs nor shorts are paying excessive premiums, so the market is balanced for short-term directional plays. For the midterm traders, those looking at swing trades over weeks to months, the strategy shifts to playing the macroeconomic narrative and waiting for technical confirmations. You are not looking for quick scalps. You are looking for structural shifts in market direction. Right now, the market is consolidating after a significant drawdown from the October 2025 highs. Your trigger for a midterm long position on Bitcoin is a confirmed daily candle close above the $76,000 resistance level, accompanied by an increase in spot buying volume, not just derivatives leverage. Until that happens, the trend remains bearish to neutral. If you are looking to short, a breakdown and daily close below the $63,000 support level opens the door to the $50,000 to $55,000 range, which CK Zheng of ZX Squared Capital and Bloomberg analysts suggest is the ultimate floor for this cycle. For Ethereum, a midterm play involves watching the $2,200 level closely. A sustained break below could trigger the $2.5 billion liquidation cascade, providing a massive buying opportunity at lower levels. The key for midterm traders is patience. Do not force trades in a choppy, range-bound market. Wait for the clear breakout or breakdown, and then position yourself with conviction. Finally, for the long-term investors, the strategy is entirely different and perhaps the most exciting of all. You are not trading the daily noise. You are investing in the infrastructure of the future financial system. The data shows that while prices are down, the fundamentals are strengthening in ways that most people are not paying attention to. DeFi total value locked is rising to $97.6 billion during a crash, which is the opposite of what happened in 2022. Stablecoin reserves are at all-time highs of $317 billion, with USDT at $183.6 billion and USDC approaching $80 billion. Experienced developers with 2 or more years of experience are at an all-time high, now accounting for 70% of all crypto code. This is the accumulation phase. Your strategy is dollar-cost averaging into high-conviction assets like Bitcoin and Ethereum at these depressed levels. Ignore the short-term volatility caused by the FOMC meetings or geopolitical headlines. The fact that stablecoin market caps are at $317 billion means there is a massive amount of dry powder waiting to re-enter the market once the macroeconomic clouds clear. By accumulating now, while the fear and greed index is flashing fear, you are positioning yourself alongside the smart money for the inevitable return of liquidity and the next major bull cycle. Let us dive deeper into the broader altcoin market and what it tells us about the current environment. Solana is currently trading around $90.71, down nearly 3% on the day and about 27% year to date. It has been recovering from lows of $77 earlier in the year and is eyeing the psychological $100 resistance level. The broader altcoin market is still struggling to gain traction against Bitcoin. The Bitcoin Dominance Index is currently at 58.36%, and the Altcoin Season Index is sitting at 35 out of 100, which firmly places us in Bitcoin season territory. This means that capital is still seeking the relative safety of Bitcoin rather than venturing out into the riskier altcoin waters. For traders, this is a clear signal. Until Bitcoin dominance starts to break down significantly below 55%, the majority of your trading capital should be focused on the major caps like Bitcoin and Ethereum. The spot Bitcoin ETFs have bled approximately $4.5 billion in net outflows since January 2026. But a brief reversal saw $1.1 billion in inflows over 3 days, suggesting some institutional players are starting to view these lower prices as attractive entry points. Another critical factor that many are overlooking is the impact of the upcoming Basel III regulations and the broader regulatory landscape. The Basel III framework, which governs bank capital requirements, is expected to have a significant impact on how traditional financial institutions interact with crypto assets. The Senate is actively discussing a crypto market structure bill, and the Genius Act for stablecoin regulation has already passed, while MiCA compliance in Europe is driving massive USDC growth. If the Basel III regulations provide clear, manageable guidelines, it could open the floodgates for a new wave of institutional capital. Additionally, Jerome Powell's tenure as Fed chair ends in May 2026, and the transition to a potentially more dovish replacement could be a massive catalyst for risk assets. These are the hidden catalysts that mainstream media is not focusing on, but they could fundamentally reshape the market landscape in the coming months. Let me also give you specific actionable trade setups for Bitcoin right now. If you are looking to play the current range, watch the $70,000 support level very closely. If Bitcoin drops to $70,000 and we see a massive spike in volume accompanied by a long lower wick on the 1 hour or 4 hour chart, that is a strong indication that buyers are stepping in to defend that level. This is your entry signal for a long position. Your stop loss should be placed just below $69,500 to protect against a sudden breakdown. Your first take profit target should be around $72,000, with a final target at the $74,000 resistance level. For a short setup, if Bitcoin rallies to $74,000 but fails to break through with a bearish engulfing candle on the shorter timeframes, enter a short with a stop loss above $74,500, targeting $72,000 and then $70,000. The US dollar index at 99.52 is also worth monitoring. A strengthening dollar puts additional downward pressure on crypto. So, what does all this mean when we put it all together? It means that you need to be adaptable. The days of simply buying the dip and waiting for new all-time highs are over, at least for now. This is a trader's market, not a passive holder's market. You need to be actively managing your risk, taking profits when they are available, and protecting your capital at all costs. For short-term traders, this means using tight stop losses and avoiding over-leverage. For mid-term traders, it means waiting for clear, confirmed breakouts before committing capital. And for long-term investors, it means having the patience and discipline to slowly accumulate high-quality assets during periods of extreme fear, knowing that the halving cycle, the institutional infrastructure, and the massive sidelined capital all point to an eventual recovery. In conclusion, the current crypto market is a complex, multifaceted beast. We are navigating a bear market characterized by a 43% drawdown from all-time highs, extreme fear sentiment, and massive macroeconomic uncertainty driven by the Fed, tariffs, and geopolitical conflict. However, beneath the surface, the fundamental infrastructure of the market is stronger than ever. DeFi is growing, stablecoins are at all-time highs, and developers are continuing to build the next generation of financial infrastructure. This divergence between price action and network fundamentals creates incredible opportunities for those who know where to look. Whether you are a short-term scalper, a mid-term swing trader, or a long-term investor, the key to success in this market is discipline, risk management, and a deep understanding of the underlying data. Do not let the fear dictate your actions. Let the data guide your strategy. Thank you for tuning in to this deep dive on Bonnie's life. I hope this analysis has provided you with the insights and strategies you need to navigate this challenging market environment. Remember, trading is not about predicting the future. It is about managing risk and capitalizing on probabilities. Stay disciplined, keep your emotions in check, and always trade with a plan. If you found this episode valuable, be sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Share this with a fellow trader who needs to hear this. And as always, keep your charts clean and your minds sharp. I will see you in the next episode.